Yeah. What are your thoughts on a 50-point wide iron buy placed around 10 a.m. to capture that? Yeah, absolutely. We can talk about that for the Fed today. Um, Price it out, see what it looks like, certainly. Hey, 007, good to see you as well. I'll talk about the trade that I have on currently as a slight hedge for the account. Um, and we'll go from there. So let's start with the intraday charts, and we will then pop up on the daily and kind of walk through maybe some trade ideas to hold through the Fed announcement itself. So, starting with SPX on the intraday charts, you can see overall we've had a pretty tight, narrow range today, and that really isn't too surprising going into the news announcement overall. I don't know if you guys hear my dog; she's like digging in her dog bed right now. Um, but basically, usually going into the Fed announcement, we kind of talked about this a little while ago where it's not uncommon let me pull up the daily chart first, actually. It's not uncommon going into the Fed announcement to not really have any meaningful move. Yesterday, arguably, we got a nice range. It tried to dip down, but notice the open and the close. We're still hanging out right around that 44.50 level. That's right by where we were trading at yesterday. And so it's usually, right, a bit more of a non event. It's a bit more chop going into the Fed announcement itself. And so, what happens typically on the Wednesday of the Fed announcement, specifically one where we can either anticipate a rate cut, a rate hike, a pause. More importantly, that Powell is going to be speaking later today and answering questions to the press. Usually, what occurs is we identify a choppy range pretty early on in the market. And it's not uncommon for the range to be narrow. Now, of course, that's not going to happen every Fed announcement, but it does happen more often than not to what we can anticipate here. Hey, Brian, good to see you. So you can see overall, our daily range has been very narrow today. The high has been right around 44.60, and we're trading right by the lows, currently around 44.50, right? So just around a 10-point range. Not a lot of action happening at this moment. On the smaller time frames, you can see here we're still trying to maintain some intraday support levels. Momentum is resetting towards the zero line on all of these, whether it's from above the axis, right? Like on the 5 and 10-minute chart, it's that bullish momentum resetting to the zero line. On the hourly chart, it's bearish momentum setting to the zero line. And that makes sense because we know that the Fed news will likely cause some sort of spike in volatility, even if it's just short lived for an hour or if it's just for the day in the second half of the day. We know that we'll get a little bit of spike in range going into the announcement. So having the volatility reset towards the zero line gives it plenty of room to spike either with a bullish sentiment and or a bearish sentiment, and have range for that move to basically work itself out. Usually we start to go into this a bit more of a consolidated range earlier in the market day. So we just had Europe close, and you can see that's, like I said, we got the majority of our movement within the first hour of market. And now we're just kind of hanging out here, slowly drifting a little bit lower, but not necessarily in a strong or meaningful way to say, hey, let me put on an intraday trade that makes sense. Hey, Joni, good to see you. And so that's usually what you can anticipate going into the announcement is you identify a range early on in the day and you basically chop into that range earlier before the lunch hour, right? Usually on a normal market day, it's not uncommon during the lunch hour to get a bit of chop and see volatility at the open and then at the close of the day. But on a Fed day, you usually start that consolidation much earlier than the lunch hour. And it goes into the Fed announcement, which is at 1 p.m. Central. So once the Fed announcement happens, then typically what we can anticipate is a spike in volatility. Oftentimes it happens in both directions, right? So you'll have a little bit of a spike maybe to the upside as well as the downside. It could be the downside first, then the upside, right? That doesn't really matter. You usually get a little bit of a spike in volatility in both ways, depending on what the news is. And then sometimes it will pause again, right? After the initial announcement until 30 minutes after the announcement occurs, because that's when Powell gets on the mic to start not only making an official comment, but then answering questions from the press. And so that is a second round of volatility that usually occurs, sometimes still in both directions. But if it's a bit more of a significant move or it's anticipated to be, right, maybe he does end up doing a rate hike again for this session. And in turn, it causes a bit more volatility depending on the market's reaction to that, right? Or maybe he doesn't do it and the market's euphoric, right? It likes what it hears and it gets a little bit of volatility. And so it's not uncommon going into a trend move following that into the close of market that day, which can sometimes make for a really great end of day pin setup. So ideally, that's what I'd like to look for if I get a chance to be able to do anything. Um, every now and then, though, what happens is, especially when you start to get into a more trending bullish market, sometimes the move's already priced in, right? And so you'll still get the spike of volatility around the news itself and then around the press conference, but then going into the close, it kind of drifts back into the range that it was in prior, and it's a non-event, right? Basically, the market's already priced it out, and then it just kind of hangs out into the close. That could also be a possibility, which if that's the case, right, then what Jay Smitty wants to look at with an iron fly would make sense to put on. So let's go ahead and price that out really quickly. And then I'll show you what I'm looking at personally going into the end of the week to maybe try and play the Fed news here. So right now we're right by 44.50. And 44.50 has been the level that we've been closing around recently on the daily chart, right? We had that close right around that range on Friday. We saw a close right around that range again on Monday. And then yesterday, we closed just a little bit shy of that. And then as you can see today, we opened at that level, and that's where we're at. So I don't blame you for necessarily considering a 50-point iron fly. 4,500 seems like a really good price level as well as a psychological level to try and hold to the upside, as well as 4,400, of course, being a good price level to the downside. So if you were to do something like this, right now it's about a 23.90 credit, $26 risk. Not necessarily a bad risk versus reward, but usually on iron flies, you can get it to a point where your profit potential is greater than your risk. So when I see that the risk is this high, and it's not like dramatically higher, right? But it is 200 points higher or $200 higher. Sorry, guys, $200. And so, because it is slightly higher, usually what that tells me when I set up an iron fly is I can usually narrow the spread width some, where it doesn't usually affect the max profit potential too greatly, but it helps reduce the capital risk. So let's just take that and let's say we reduce it by 10 points, right? So instead of a 50-point spread width, we're looking at a 40-point spread width. And you can see on the max profit potential, it brings it down from $24 to 22.30. So you lose about $1.60 of profit potential, right? That's not a lot that you're giving up for that max profit. But on the risk side, you went from $26 down to 17.80. That's just a little under $9 of risk that you've taken off the table. So if you're okay losing about $1.60 of profit potential in return for reducing your risk by, $8 to $9, then you might actually consider something like this, Jay Smitty. Now, I know, of course, the longs, right? The downside to doing this slightly is it technically narrows the range that you're giving the underlying price to move. And of course, 45 and 4,400 seem like great psychological levels to place those longs. But remember, technically, your break even point is the premium that you receive. So you're really not affecting too much the break even point on this iron fly, right? You're only dropping it down by $1.60, if you will. But it really helps reduce the risk. And to me, this looks like a much better risk versus reward compared to having it further out of the money on the long strikes, where yes, it does increase the profit potential a little bit, but it greatly increases that risk. So if you're willing, of course, if this is within your risk tolerance to put on $17.80, then and you think that the market is going to have a bit more of a non-event, or you're looking to maybe have the spike in volatility, it resets itself right around 44.50 before the press conference, and you're looking to just take a quick scalp on the theta decay that occurs in between the initial announcement and then when he starts the press conference, by all means, go for it, right? Do what you think is best for your account. I don't think that's necessarily a bad setup if that's what you're thinking is going to happen through the Fed news. So if you think it's going to be more of a non-event, that everything's already priced in, it's going to hang out here, then this doesn't seem like a bad trade idea to consider. And just remember, your break-even point is the credit plus and minus, depending on if it's a bullish or bearish move, your pin strike. So to the upside, your break even point is 44.7220 in this case, right? Because it's 44.50 plus 22.20 of credit that you receive. And then to the downside, your break even point is 44. What is that? Like 44.30 and change. Let me get out my calculator so I can give you the exact number here instead of trying to do mental math. So 44.50 minus 22.20 is 44.2780 is your break even point to the downside if you get a $22.20 credit fill for the trade. So, and absolutely, hey, Corey, a tug of war spanning the global financial system. It certainly is that way. I know Fed futures, last I checked, basically everyone's pricing in that they're not going to do a rate hike this time. Which, once again, if that is the case, then it could be a situation where the move's already priced in and a non-event trade, kind of like an iron fly, solely looking for that theta decay to work in your favor, looks good. Hey, Toby, good to see you. And then Brian's asking, would a strangle or straddle make sense with the possibility of an up and down move closing each side when it swings favorably in your direction? Absolutely. And that's actually kind of what I have on currently as a slight hedge for my account, if you will. This was a strategy we used quite a bit more last year because the volatility was certainly there last year in the market around Fed announcements and CPI. I haven't done this strategy as much this year just because, in all honesty, right, we haven't seen the same type of volatility that we got last year. Right. Last year, we had a lot of volatility around Fed news, Powell speaking, even when it wasn't a rate hike or rate cut decision on CPI inflation data, to where this, doing something like a straddle or a strangle or the, strategy I'm about to walk through, the compound butterfly, makes a lot of sense putting on. But this year, it really hasn't played out that way. So I haven't done this strategy. I did it like once or twice earlier in the year. And when I realized, walking through my trading journal, it just wasn't hitting the same profits that it was last year. I kind of put the strategy back in my toolbox and haven't been using it at least around these news events as frequently. Now, earnings, I've still been using it some, but not around, Fed announcements or certainly not around CPI data. That was definitely a non-event recently. But this one I did decide to put it on for partially because at least the levels that I was looking at, it was inexpensive. It could act as a slight hedge for a bullish or bearish sentiment, but also because if he does end up doing a rate hike, right? If the Feds end up doing a rate hike and everyone's pricing in that he's not going to, well, that could spark a little bit of volatility. So I'm not necessarily anticipating it, Brian, but I think it's a possibility. So let's walk through what I think looks like a potential good idea there. So what I did is I went out to Friday's expiration. And there are two ways you can put this on. For those of you in the small account mentorship, this is kind of a review of what we talked about yesterday whenever we placed this trade. But I personally went further out of the money within levels of the daily chart with the idea that if we do get a little bit of a spike up or a spike down, going into the end of the week, right? So not necessarily just playing it for today's expiration, which would be, arguably a little bit more of a lotto, but playing it through Friday. That way, if we actually get a run up or a run down, we have the flexibility of holding this a couple of days to try and reach those levels. So what I did is I placed one broken wing debit butterfly at the 45.20 range. You can see right now it's about 55 cents. So it's really not that much of a cost. Excellent profit potential currently. So a 60-cent cost basis, let's say 9.40 profit potential if you get the pin on Friday. If it blows past it though, let's say it really keeps running to the upside because it's a super strong conviction of a move, then it has the forgiveness factor that if it goes completely in the money, because of the difference of spread width, because the debit spread side of the butterfly is 10 points versus the credit spread being only 5 points, it still allows for a profit potential of 460, right? Because the trade itself would settle for five minus, because that's the difference of spread width, right? Five minus the cost basis of, let's say, 60 cents in this case, would still be a 440 profit potential. Not a bad risk versus reward. But keep in mind, we have no idea how the market's going to react to this news. So, on top of doing one on the call side, I also have one on the put side. Now, the reason why I chose the strikes in this range is one, for myself, when I entered this trade yesterday into the close, my total cost basis on this trade is $1. And I really wanted to keep it at or less than $1, right? Really treat it like a hedge to where it's a small amount of capital risk. If it doesn't work out, it's not blowing out my account whatsoever. But if it does work out, it allows for that really excellent risk versus reward scenario, to maybe kind of help make up for some of the losers in my account that might be slipping behind, if you will. And so the levels on the call side I placed to where they're still inside where the ATR trailing stop is, and that is at 45.3776. So if we were to start to get a stronger build up into the end of the week into that level, right, a bounce off support here and a continuation, then there's a good chance that this butterfly could be at or in the money, depending on where it starts to stall. The second reason why I did this level and for this cost basis, though, is because it is really inexpensive. So if we do start to get a volatile push to the upside, and let's say we go up to 4,500, our butterfly will still be out of the money. But because we got into both butterflies for around $1, if we're just a little bit outside the money on it, the value on this should still allow for profit, even if it's not, that max profit potential or that 460 profit potential could still allow for around $1 profit on the trade, right? So we could at least scalp a quick win given how inexpensive it is, even if it can't get all the way up to our strikes. So that's the second reason why I kind of went with this level. I went further out of the money and kept it really cheap. So that way, one, it's well within my risk tolerance because, like I said, this strategy hasn't been working as well this year, specifically around Fed news like it did last year. So I didn't want to necessarily go in with the normal capital risk I look at on this trade, which we'll talk about in a second. Um, but at the same time, if we do start to get a move, there's still a good chance I can get some sort of profit out of it. That's the idea. On the put side, right? So that's the call side. The put side over here, I did around 43.60. Why is this? I don't know why that's being weird. There we go. And right now you can see the put side is around 30 cents. So definitely a bit cheaper compared to what I paid for it yesterday. Still though, around that dollar cost basis in total that I paid for. So, it's a little bit more expensive on the call side currently, I guess arguably because we bounced up some, a little bit cheaper on the put side. So if you did want to bump up your strike sum on the put side, you could, right? Don't let me stop you. But in total, it's right around that dollar cost basis. And the reason why I chose these strikes is because at least as of yesterday, we've moved up, of course, a little bit with the 100, but the 100 period simple is currently at 43.74. So if we do start to get some selling instead and go down to test the 100 period simple, well, then that's going to be right by our strike level. Of course, if usually the market reacts in a negative way, it's easier for the bears to get a run going. So if we start to try and break the 100 because it's a bit more of a volatile move lower, then there's a good chance this could still go in the money. And so in total, right, between the two butterflies, which I paid $1 for both of them combined, right, $1 total cost basis on the call and the put side. The max profit potential is $9 for the pin. Excellent risk versus reward. If it goes completely in the money on one side or the other, it still allows for a $4 profit, which is a 400% return on risk. So this is how I look to do it. Now, if I were to do this in the more traditional sense, in regards to levels as well as the normal cost basis, I usually try and stay within for this trade idea. Then you could arguably look to bump up the strikes, and actually put them at the psychological and price levels of 44 and 4,500. So let's price that out really quickly. On the put side right now, the 4,400 level is about 95 cents. So right around a dollar. Let's just call it a dollar. So a dollar for the put side. And remember, this is for Friday's expiration, not today's. And then if we were to do this on the call side at 4,500, it's about a dollar 45. So in total, you're paying about 240, 245 for the trade. Now, obviously, that's a bit more expensive than how I placed my trade because it's closer to at the money. The good news around doing it closer to at the money is you don't need the price to move as dramatically in order to get back up to 4,500 or to get down to 4,400. So if you think that's a bit more of an obtainable level of 50-point move into the end of the week, which I think is, definitely a possibility, and you don't mind putting a bit more capital risk out there, then you might consider moving your strikes up, paying that 240 cost basis. That way, if you get the pin, right, just to show you guys the math, it's a 760 max profit potential at a pin either at 45 or 4,400 at the end of the week. And then if it goes completely in the money, it still allows for a 260 profit because once again, the difference of spread width here is 5 points. So if you're completely in the money on the call or the put side going into expiration, it will cash settle for 5 minus our cost basis of both butterflies combined being at 240 is a 260 profit potential. So still a little over 100% return on the risk, not bad. The reason why I personally didn't want to do that, even though I do like the levels and I think they're probably more obtainable than my levels necessarily. The reason I didn't want to do that is I didn't want to put 240, 250 of risk out there personally. Just because, like I mentioned, the strategy hasn't necessarily been the best one to play out with around Fed news. So if the Fed news is more a non-event to where Jay Smitty's iron fly is what, is going to be the real winner today, I didn't want to lose 240 of capital into my account. A dollar, I don't mind losing a dollar. But 240, I'd rather keep that extra 140 for maybe a little bit less riskier of a trade, right? A bit more of a traditional setup, if you will. And so that's one way, Brian, you could look to do it and play for the more volatile move, if you will, to the up or downside. The one thing I will point out, though, is if you're trying to do it for today's expiration, keep in mind the option premiums right now are a bit more spiked than what they normally are. We've had a 10-point range today, but notice how these at the money strikes are still holding on to quite a bit of value compared to what they normally would look like if it today wasn't a Fed day and all we've had is a 10-point range. And the reason for that is because of the uncertainty around the move. So if you were to, let's just say, go out here and pay for a long on each side on the call side and the put side, it's costing you about 14.70. So not only do you need a move to your strike, you need to really go past your strike as well. And if it's a non-event, the theta decay is going to rip out of this trade. Or let's say you get that spike of volatility. If it's not a big enough spike of a move, then the theta decay is still going to crush on these two longs. And so that's why personally, by playing the volatile, aspect of it, if that's what you're anticipating, kind of like what I'm doing, that's why personally I went out to Friday. So it gives you at least a little bit of time to where the premium's not going to get completely crushed like it would today on a non-event. And two, it gives you a little bit more flexibility to play for maybe a run up or a run down following the news event itself. So I hope that kind of helps you guys out. But those are two different ways to play the Fed today, depending on if you think it's going to be a non event or if you think it's going to be a bit more of a trending move up or down. I don't necessarily anticipate it breaking strongly out of our overall choppy range that we're in. But because we are in the middle of this range, it wouldn't be out of the question to try and go at least test the top or bottom of it, depending on what the market reaction is. And then Corey says he's guessing it's a buy before and sell after, buy the rumor, sell the news. Markets will realize the implications of a dovish Uncle Sam Powell and not love where it might take us. That could certainly be the case. That it's already kind of priced in, but once they realize, like, hey, this might not be actually the best idea for the economy or whatever else, right? Maybe it sells off. But keep in mind that we can try and put as much logic around the news as possible. And I know I've talked about this before, especially around Fed events, right? Where you're like, this is what the Fed's doing. So I anticipate this is how the market's going to react. But the market's like a fickle beast, right? It really does what it wants to do. And so, as much logic as we'd like to put out there around the market, we know that at the end of the day, it's going to react however it's going to react. It's emotional. And so, because of that, the only thing as traders that we can truly control is the capital risk we put out there, which is why, personally, right, for my broken wing butterfly trade idea, the compound butterfly, one on the call side, one on the put side. That's why I made sure to keep it at a dollar risk because I know that's really the only thing I can control. And of course, I kept my strikes at levels that I think are obtainable, that are within this overall choppy range that we've been in arguably since, August. Um, and so I've kept the levels right where they're at, but I made sure it was a cost basis that's well within my risk tolerance because that's the only thing I can control in the market ultimately is how much capital I'm putting out there to risk. Um, because I've seen it before where one time it was like, okay, they're anticipating not to do a hike. They did a hike, but then the market reacted positively to it. And it's like, I wouldn't have anticipated that, but sure, go for it, market. Um, and then what is ET? Can it be traded like any other option? I'm not sure what you mean by ET. Is that just a symbol? Sorry, Jace. There are options available on it. So if you're talking about ET in general, the answer would be yes. We can pull up the chart here and take a look. Was there something that you saw on the chart specifically that you want to look at? And then Joni, could I please review how you arrived at the strike range for the call side? Absolutely. So I'll wait for that to pop up. We'll go back to ET in a second and see if that will load for us on the charts. There are options around it though, so I've never traded each ET personally though, so I probably wouldn't be the best person to ask about it. It looks like it's something in energy. So Neil might be a good person to ask about it whenever he comes on the mic here in the Simplers Essentials room. He does a lot more of the commodities and that kind of stuff to where he might have a better idea around it, or Mary Ellen might have a good idea. And Corey, you actually have a strangle on ET right now. And it's oil field services. Okay. So the way I got to the levels once again on the call side, I wanted something at or below the ATR trailing stop. So initially, I actually started with I believe a 45.25 pin, but it was a little rich when pairing it with the put side. And I really mean a little rich. It was basically over the dollar cost basis that I was looking to try and net both of those butterflies on. And like I said, I'm very strict about my risk tolerance. I really wanted to keep it at or below a dollar cost basis as much as I could when entering this trade. So because the 45.25 pin was just a little rich, and that's because we were also bouncing up into the close yesterday. So the market makers were keeping that premium in there. I went with a slightly higher strike set, which once again, let me go back to the option chain so you guys can see that. So I went just a strike set higher, right? From 44.25 to 44.30. Still encompassed 44.25 as a psychological level, but overall the strikes themselves are below the ATR trailing stop. So if we go up and tag the ATR trailing step, stall and get a little bit of a pullback, the idea is we'll be right in the sweet spot still of this butterfly. So that's how I chose those levels. Hi, Ivan. Good to see you. And then Tom's asking, good morning, missed your early comments. Did you say you also have a put fly on SPX? And if so, could you repeat the trade levels? Yeah, Tom. So I have one at 45.20, 45.30, 45.35, a debit broken wing butterfly, and this is for Friday's expiration on the call side. And then I have one at 43.70, 43.60, 43.55, which I think this one you could bump up some strike wise personally, as long as once again it's within your risk tolerance, of course. And that level is to try and trade right around the 100 period simple. So that way, if the Fed causes a negative market reaction and we get some selling back down into this price level and support, we're right by the put strikes of that butterfly. And if we get a rally to the upside into the ATR trailing stop as resistance going into the end of the week from the Fed announcement, then we have something on the call side. And if you did miss the session earlier, I did talk about how this is a really cheap, almost slightly hedge. So it might not get all the way to our strikes to where you could still take the profit on it. You might not hold it that long. If you want more of the traditional strategy of the compound butterfly that we typically look at, then you might consider 4,400 and 4,500 as the pins for a debit broken wing butterfly. That obviously would only need about a 50-point move up or down and would probably be a bit more obtainable. The downside is when we price that out just now, both butterflies combined are about 240, 250. So you're paying about $1.50 more for the trade idea compared to what I paid for mine. But the levels are a lot closer to the underlying price currently. So you wouldn't need as big of a move in order for that to go at or in the money. So it just depends what kind of capital risk you want out there. But if you do play the volatile route, personally, I would keep it for Friday's expiration. If you want to play purely off the theta decay crush and you think it's going to be a non event today, right, where we get a little bit of spike in volatility around the news, but then it settles back out where we were trading at, right now, basically before the news event happens, then I would do today's expiration on an iron fly. And keep in mind, we priced out a wide iron fly. And if you like that idea, but you're like, I don't want $17 of risk out there, you can always narrow it, right? You could do something like a 20-point iron fly. And that's going to be a 15.30 profit potential, 470 risk. You could do a 15-point iron fly. Just keep in mind, the more that you narrow the spread on each side, it means you're giving the underlying price less room to move for it to be profitable. The plus side to doing that, of course, is that you really reduce your capital risk. So, and as we talked about just a second ago, risk really is the only thing you can control in this market. So, be mindful of that. But if you're playing the premium crush, I think today's expiration would probably work better for that. And then Ivan, can we look at Apple? Absolutely. Let me write that down. And then Toby's asking really quickly, when you're putting on your butterflies, the ones that are way out of the money, are you putting them both on at the same time or one at a time? Usually for this strategy here, I'm putting them on at the same time because the idea is I'm anticipating some sort of volatile move around the Fed announcement itself. Ideally, bringing that volatility or at least a trend move into the end of the week. So I want to put them on at the same time because I have no idea how that move is going to go. I just am assuming, right, there's a good chance of volatility. And so that's really what I'm playing. That's why I want both a call and a put side. If this was a more, directional trade I had in mind, then yeah, I'd probably only be playing one side or the other. But this trade strategy right now that I'm currently having out there, this type of compound butterfly, if you will, of two debit broken wing butterflies, you're playing more off the idea of volatility than anything else. This is actually usually a really good strategy to put on around earnings. For example, we did this in quarter one, off Meta earnings, for example. And actually, I think we might have played Meta a bit more directionally, but in general, usually, I play both ways off earnings announcements, and you can, play for the volatility around an earnings announcement like that. Same kind of idea that you're anticipating volatility and trying to make it work. And then Ivan, yeah. So if you wanted to do, yeah. So I think, if I remember correctly, we actually played the first quarter a bit more directionally, specifically because the first quarter of this year, a lot of trades, a lot of companies, if they had a bullish divergent bar going into the announcement, because of all the selling that we had last year, a lot of these things popped up on their first quarter earnings. As long as they, were in line with their sentiment or they beat sentiment, you saw a lot of bullish moves. But outside of this, let's say we did like the next earnings quarter, right? The second one of the year, that one I would have played both sides on. So the start of the year was a little bit different because of the market environment that we were leaving the bearish sentiment from last year going into the start of this year. But usually around earnings, I play both sides if I'm playing volatility. And then for SPY, so I talked about this yesterday. On SPY, personally, I know some of you guys can't trade SPX, which is why you ask about SPY. So if you're looking to play the not the theta decay route, but the volatility route, personally, I would probably keep it still to Friday's expiration, but instead of a butterfly because of how SPY is priced, I'd look at 2 vertical spreads. And I would still try and keep them around the levels that I mentioned. So at the 100 and ATR trailing stop or inside that range. So to the call side here, for example, you could do, maybe something like this, the 447, 450. That's a 3-point spread, 63-cent cost basis. If you do something similar on the put side, you might look at something like this that keeps you right above the 100. It encompasses those psychological levels of 440 and 450. It's about a $1.23 cost basis, $1.77 profit potential. So still not a bad risk versus reward. Obviously, of course, it's not as big of a profit potential as the butterflies are on SPX, but it's you're trading SPY, so it's going to act a little bit differently. If you wanted a smaller risk, you could always narrow this to like a 2-point spread, right? If you want a slightly better risk versus reward. Not a problem, Ivan. And, Joni, it should still work, right? Ideally, it should still work. Personally, if I were to do this on SPY over SPX, I'd probably, just like I show here, try and keep the levels a little bit closer than how my SPX butterflies look, right? A little bit closer to at the money. And it's still more than likely the risk versus reward is going to look a little bit more even. I wouldn't do a broken wing butterfly on SPY just because the premium that you're going to get on the credit spread side of the butterfly to me isn't really worth having out there, right? It's going to reduce your risk a tiny bit, but not by a lot. And then you're having to pay more commission because you have more legs and strikes out there overall. And Toby, not a problem. Yeah, happy to answer both Joni, you and Ivan. And then, yeah, if you wanted to do the theta, y- the issue on theta, of course, on SPY is one, you will have to day trade out of it if you do today's expiration because the premium still spiked up here, but SPY has the risk of assignment versus SPX, right? SPX is cash settled. So you could put that on, let it go into the close, forget about it, and wherever it lands, it lands. And you don't have to worry about shares or anything like that. But SPY has the risk of assignment. So you would have to day trade this going into the close today. And if you were to do something here, I would probably, let's just kind of price this out, 4,400. I'd still kind of probably one around 44, 4,500, but that's not right at the money currently. We're kind of in between 443, 444. So if you're really trying to keep it even, you might do something like this 4-point iron fly. Currently, it's about a 226 credit, 274 risk. Now, the same thing applies to what we talked about earlier in the session, which is usually when the risk is a little bit more than the profit potential, you can bring in your long strikes and it's not going to greatly affect your profit potential much, but it should reduce your risk quite a bit. So here we lost a little bit of profit potential, but notice now the profit potential is greater than the risk. It's at least a little bit more even. So, oh, actually, I had different spread what's on. Sorry, guys. That was my bad on the math. So 4 points on each side. This actually that's why it looked a little different. 220 profit potential, 180 risk. I don't think that looks bad. So if you wanted a theta decay crush trade, this might be the way to go. But once again, one, on something like SPY, given the risk versus reward here, you might have to hold it a little bit closer into the close today. And two, I would definitely treat it as a day trade. If you wanted to go out to technically like tomorrow's expiration and do an iron fly, you could, right? And still try and day trade it, but you won't get the same crush and premium as you would on today's expiration. Jay Smitty, have a great rest of your day. I'm always happy to help. And then Ivan, can I just take the 10% of SPX on SPY when you send the alerts? I'm a little confused by your question. Are you saying can you just take the 10% profit? Absolutely. You can you do whatever you want, right? It's whatever you think is best for your account. So certainly go for it. And in general, if you are saying, yeah, so that's what I thought. If you're saying, whenever I send out an SPX trade, could you do something equivalent on SPY? Absolutely. Absolutely. Just keep in mind the difference on how those settle, right? The cash settlement versus the risk of assignment, if it's like a same day expiration. And then also understand that if I'm doing something like a butterfly, you might first try and price out a vertical spread instead of a butterfly and see if that makes more sense for SPY. Yeah, Toby, iron butterflies are great, right? Iron flies, iron condors. That's a great way to do the crush on premium if you think it's going to be more a non-event. And Ivan, I totally get having to trade SPY. And Joni, the reason why is the theta's sensitive on SPX is just because of the range, right? So just like Ivan mentioned, SPY is basically 10% of what SPX is. So because of that, right, on the option chain itself, you're just going to have more premium to play with on SPX than you would SPY because it's worth 10 times more. So that's how that theta decay can really work in your favor. The downside, of course, is you usually have, or you have the possibility of having more risk on SPX, depending on your levels and where you're pricing it. Yeah, of course. And Roland, that is true. You could trade XSP instead of SPY and not have to worry about being assigned. The downside is XSP, from at least I personally don't trade XSP, but if you do, it's just from my understanding a little bit less liquid. But you could actually absolutely go to XSP and have I believe it's cash settled as well, if I remember correctly. And, yeah, FDR rate increase today, market's going to fall. I think it's a possibility, but like I mentioned earlier, the market is a weird emotional beast, right? And that's kind of us trying to put logic behind what you would anticipate to happen, that if there is a rate increase, the market's not necessarily going to like that, and you would think it's gonna fall. But there was a time not too long ago where we weren't pricing in a rate hike, we got the rate hike and then the market reacted positively to it. So, like I said, as much as we want to put logic behind the potential move, the market's going to do what it wants to do. So, and yeah, absolutely. If you wanted to do a vertical spread instead of a broken wing butterfly, you absolutely could, Orlando. If you want to do that on SPX, then you might just consider a smaller spread width, right? To keep it within your risk tolerance. So, for example, if you did the closer to at the money strikes at the psychological levels of 45, 4,400, remember on the butterfly portion of that, that was about a 240 cost basis when we priced it out. If you did a 5 point butterfly, it keeps you around a similar cost basis of $1.90. Max profit potential, of course, is reduced by quite a bit to 310, but then, once again, it gives you the ability to play the trade, and try and take a profit if there is a volatile move into Friday. If you want it to go closer to my strike levels, you of course could, and it will be a bit cheaper. So you could do something like this on the put side and then bring that a little bit higher on the call side here. And it's about 80 cents, 420 max profit potential. So you could absolutely do the vertical if you'd prefer to do that instead. Just clear that. There we go. And then Corey mentions XSP is fine, but you have to use strikes that have volume and open interest. Otherwise, it's not worth it. And that's, yeah, exactly what I mean by it's not as liquid, certainly as SPY or as SPX. So you just want to be a bit more mindful of that when you're trading it. So let me go back. Let me see if ET will even load on the charts here. If it doesn't, we'll skip it and go to Apple. Make sure we get through everything you guys want to look at before I have to sign off here. There we go. So on ET, from at least what I can see from a chart perspective, overall, it's been in consolidation quite a bit. It's trying to get that bullish run going. We reached a bit of exhaustion here, so it pulled back at least a little bit while the price kind of pulled back and chopped into the 10. It held. We started to see momentum pick back up, and that's allowing for this next kind of leg to the upside. The caution I would have here, of course, is momentum is still rather high, right? Oh, no, it's not. Okay, zooming out. No, it's not. Here's the top of the axis at exhaustion. So actually, we went up, broke this price resistance level that we had at 1350, pulled back a little bit, held it as support. That's a really good sign. And now we're bouncing back up to try and keep going in the trend. And there is room on momentum for this to continue higher. We got our bullish signal again on the compound breakout tool. We actually had a recent true low last time we printed the true low back here, right? That was a good spot to buy in general. So it doesn't look too bad. Um, from a weekly chart. Just keep in mind, the reason why, this looks the way it does maybe on the option chain is because it's not necessarily a big range of movement. This is priced at $14. And as soon as the weekly chart loads up, we'll take a look at, what a normal weekly range looks like. But that could be why on the option chain, for example, when we go out here to October, which is 30 days out, these strikes still don't have much value. And part of that is probably because we've been chopping quite a bit this year. Notice how flat we've been this year. And then as for ranges, 35-cent range, 38-cent range. Let's see, a wider range was just shy of 50. Big ranges back here were still under a dollar, or right at a dollar 13. That I think was the widest weekly range we've had this year. So understand the strike increments 15 cents, 50 cents. I mean, excuse me. So if I were thinking, yeah, this looks great to the long side, the weekly squeeze is just firing. All of this is bullish. We're getting that next push to the upside from a daily perspective. One, it's not necessarily the best spot to jump in, right? That probably would have been either on Monday at the start of the week or last week whenever it confirmed it was holding the 1350 price level as support and then trying to play for the bounce. But two, this is and the capital cost allows it, thankfully, but this is definitely one of those cases where I would be in the money with at least a point 0.7 delta or higher, with the idea that one, I probably actually got to November, right? Give yourself plenty of time to play the move. And then two, go in the money. That way, if it's only a 50-cent bounce up, you're playing it off a strong delta. So that way, if it's only a 50-cent move that happens, in the next 58 days, the idea is one, you have intrinsic value already built into the strike. And two, because of a point 0.8 delta, a 50-cent move should still allow for at least some sort of profit compared to if you started out of the money. If you started out of the money and all we do is move up 50 cents by November, well, this is still going to be worthless, right? So if I was trading ET and trying to play it directionally, that's what I would probably consider doing. Yeah, Joni, I do actually. So, I'll post. Let me go over Apple first, but I will post that in the chat at the end of the session. The shared link I'll share with you is technically my intraday grid setup. But as you can see, all the free indicators that I use on my intraday chart, all the indicators in general that I use on my intraday charts, outside the true low, which is a proprietary indicator here at Simpler Trading, are the same ones that I use on my daily chart. So the shared link that I have on my that's easy to access for me, that is going to be in an intraday grid format, but it will have all the free indicators so you can save the study setup and then place it on your daily chart or wherever else you want to. Of course. So let's go over to Apple really quickly, and that will be the last thing that we talk about here for the day. So let's just start from a weekly chart because Apple for me right now is kind of in a battle. So on the weekly chart, this is naturally a place that I would want to start considering buying in at. And the reason why is it had a nice pullback, right? Pulled back in momentum towards the zero line. It's still above it. So the bulls are still more favorable at this point. If we can start to pick back up in green bars again, then that's going to be a stronger bullish trend signal to try and roll back up. Our compound breakout tool is still in consolidation. That makes sense with the Bollinger Bands being flat and with the price itself just kind of hanging out here. And as we consolidate, we are building energy into a low compression squeeze right now on the weekly chart. So with the overall trend of the moving averages still being of bullish sentiment, the fact that we're holding the ATR trailing stop in the 30 period simple as support, that we have a squeeze, that we have room on momentum to try and move higher. This right here would be all me taking into consideration a potential bullish trade to the upside, especially if we could start to get some agreement on these lower indicators like some green momentum bars or a bullish signal on the compound breakout tool, right? That at the very least could have us go up and fill a daily gap. That's what this alert is for, is at 190.69, if not maybe the top of the axis or, the next leg higher in this bullish run. So from a weekly perspective, I like the level that it's at. It looks good, as possibly continuing to hold and being a buy-in opportunity. On the flip side, though, unfortunately, the daily chart is actually looking a bit weak, right? We are, as soon as it pops up here, you'll see, but we are trading below the 100 period simple on the weekly chart. That's never the best sign for bulls, right? That adds a little bit more bearish sentiment to it. And we're just waiting for this to pop up, but we tested close to the 100 recently. When we first broke below it, that kind of failed. We dropped back down. So here's what I'm talking about. So we had the slight pullback, then it started to run, and then we pulled back again, ended up testing the 100, failed, dropped back down, and now we're attempting to kind of bounce up again. But you can see here we're struggling, right? Now the good news for us, if we're a bit more bullish on Apple, is it's doing a really good job of holding 175 as a price support level. And that's, of course, also because that's right around where the weekly support is. So we're holding it from a technical perspective on the weekly chart as support. And then from a daily perspective, we're at a price support level and that's holding. The downside for us is we're trading below the 100. The trend itself, the 10 is now officially crossed below the 30 and both are below the 100. So from a daily chart perspective, this is actually going into a more bearish trend. Momentum is helping with a bit of a pullback. We did cancel out of our bearish signal, which I like, but we are also attempting a bearish divergent bar today. That, of course, could change off the Fed news. Apple's such a big component of the market that, will likely move with the market depending on what happens with the Fed. But if the market starts to sell off, right? That's probably not gonna help Apple in attempting to hold weekly support or more importantly, get a bullish run going. We could stall or we could start to, actually get a bearish trend and a stronger pullback on the weekly chart, which is what I'm kind of not liking at this point. I do like the true lows. That kind of helps out with the possibility of this being a bullish buy, especially with the Bollinger Band still being relatively flat here. Um, but I'm just not a fan of this being below the 100 right now. And unfortunately, for those of us who were long, I was started to get long back here. I had a small profit on this, but I was looking for a bigger trend to move to the upside, which is usually what the true lows give us, right? The last true low that we had on the daily chart was back here. And you can see it had a short term run, but also a beautiful longer term trend move to the upside. And then prior to that, we had the true low set up here. Once again, you can see a short term run up, as well as, of course, this was a great spot to buy in general, even if you're still in shares, for example, or a leap, we're still above the level that you bought in at from an underlying price perspective back there. So usually the true low, especially on Apple, when it's been going into a bullish trend, is usually a great buy-in spot. You go out at least 30 days, if not maybe more, you buy a long call and then you play the course. But here, unfortunately, China came out with that news about, restricting government employees to not be able to use Apple anymore. And then, of course, we also had the Apple event, which sometimes gets selling around the event itself. The underlying, the Apple, the underlying price itself will sometimes sell off going into that news event. And so it was kind of a double whammy, which brought us back down here into this range. So, of course, the question is, does the market react positively to the Fed news to kind of help keep this propped up a bit more? Or does the market react negatively to the Fed news, which could kind of help with the catalyst of Apple attempting to roll over, break the 175 level, break weekly support, and maybe get a stronger downturn? So that's kind of the dilemma I have on Apple right now. I would prefer to take this long just because Apple's naturally a bullish, sentiment chart. The weekly chart looks really good, and we have the daily true lows. So that's certainly what makes me interested in it. And I might actually consider building into the long trade I already have out there currently, but I'm not planning to take any action prior to the Fed news. I might not even take action on it until the end of the week to kind of get the digestion, if you will, of the Fed news. And then to see how that happens. Because keep in mind, before I go here, I'm a little over, but that's okay. Um, Remember, when the Fed news occurs, you'll get the initial move itself the day of. But sometimes what happens, and this happened once again a lot more last year than it did this year, but sometimes what happens is the market reacts one way the day of, right? So let's say the market pops, it's euphoric, but then overnight it kind of digests the news a bit more, right? It's like eating some good Tex-Mex where the day of you eat it, it tastes great, it's wonderful. And then the next day you might have a bit of a stomach ache, right? Maybe it didn't sit so well in the gut. And then the market itself kind of reverses in the opposite direction. And that's because people, they like to analyze and nitpick at any word choice that Powell uses. And so it gives them just the time to actually kind of analyze what he said, really dive into, what was being said maybe by other feds if they talk to the press after that happens. And then that can kind of change the market reaction going into the next day. So I don't necessarily have a good day off the top of my head that I can look at back here. I'd have to pull up a longer time frame, um, which I can do that really quickly. Let me go back to 2 years. Hopefully, this will load quickly. There's one day I remember specifically where this happened last year, so just to give you guys an idea of what that looks like. Now, once again, that happened a lot more last year than it has this year. Like I said, we haven't seen as much volatility this year around the Fed news, so it might just stay the course of it already being priced in. It's a non-event. I wouldn't be surprised if that happened. That's part of the reason why on my volatility trade, I, 1, went out to Friday, but 2, really kept my risk at a dollar well within my risk tolerance. Um, But here, it was the Fed day, I remember. So here's a day where Powell talked. The market, I don't even know if it was a Fed news event day, but I know Powell spoke back here, had a strong bounce to the upside the day of, right? The market loved what it heard that day of. But then the next day, it kind of digested that news and was like, hey, this actually isn't that good of a news event. Like, whatever he said, it actually doesn't sound that great. And so what happened is we gapped a little bit lower. We sold off, and then the trend in the following move, right? The digestion of that announcement was actually another bearish leg lower. And so that could also be a situation that we run into here. So just be mindful of those possibility, guys. Ivan, may the odds ever be in your favor for that Apple trade. Yeah, exactly, Corey. A bad oyster, right? It tasted good when you first ate it, but maybe it wasn't cooked all the way, or he had a little bit of food poisoning, right? And that next trading day, the reaction's like the complete reverse. So we'll see how it goes into the close. Once again, guys, be mindful of your risk playing it through the Fed announcement. And as always, my fellow Jedis, may the trade be with you. And I look forward to talking to y'all next time. For anyone over in the small account mentorship, I should be on for the close today unless Ruby decides to come early. So I will keep y'all posted. And of course, if I do take any action on any trade, even if Ruby's popping out, I will make sure to get alerts sent out to you guys. But have a wonderful rest of your trading day, guys. And I will talk to y'all again later. Bye.